Welcome to the fourth quarter 2022 review webinar for the Rpar Risk Parity ETF and the UPAR Ultra Risk Parity ETF. My name is Damien Basserier. I'm the co-CIO of Evoke Advisors, and I'm joined today by Alex Shahidi, also co-CIO of Evoke Advisors. Today, we will have our normal format, which includes a brief review of the strategy to start. Then we will go through some frequently asked questions that we're receiving from clients, and we will make sure to answer any questions that the attendees have as well. If you have a question, please use the Q&A feature in Zoom. So just upload your question and we'll make sure to cover it during the course of the conversation. I will turn it over to Alex.
Hi, everyone. Thanks for joining us. As usual, what I like to do is just start with a quick recap of the strategy, just to get everybody on the same page. And then I'll start on this page that you see on your screen now. So risk parity is really more about a framework, an investment framework, than anything else. And most investors are used to what we call the traditional efficient frontier, the traditional investment framework. And investors have the option using this framework of investing in low risk, low return bonds or high risk, high return stocks. And typically they allocate across those two, depending on the target return and risk that they're seeking. And the issue with this framework is investors sacrifice portfolio efficiency or diversification to increase the expected return. In other words, the more return you seek, the more concentrated the portfolio becomes in equities, and as a result, it becomes less diversified. And that's an issue because we all know equities go through significant downturns. They also can go through very long stretches of underperformance. So we're seeking a better framework than the traditional allocation. So risk parity is just a different way of constructing a balanced asset allocation. And it can effectively avoid that flaw of being overly concentrated in equities to increase the expected return. So the risk parity sits where you see on your screen on that efficient frontier. This is our estimate, where we expect something like 60-40 risk over the long run, but an expected return that is competitive with equities. So the first question we often get is, how can you get a higher return for the same level of risk as 60-40 and do it in a passive way? It's not assuming any trading or taking advantage of market movements. So we think of this as basically coming from two sources, and these are principles that many of us are very familiar with. The first is more diversification. If you can build a portfolio that is more diversified than 60-40, then its return to risk ratio, often called the Sharpe ratio, is going to be higher. And if you can just hold that same portfolio at the same risk as 60-40, then mathematically it should have a higher expected return. So that's principle number one. Number two is this concept of a rebalancing boost, where you're invested across a mix of assets. And there's a regular rebalancing process, which we think of as a buy low, sell high, repeated process. And if you do that over time, you can actually boost your returns. And in a moment, I'll show you the math behind it, but the boost is greater, the more volatile the assets and the more diverse the assets. And we think risk parity takes full advantage of these two principles. So how do you construct this risk parity portfolio? We think of it as two distinct steps that are very different from one another. The first is deciding which asset classes do you own. And we select equities, commodities, tips, and treasuries. And the reason we pick those four asset classes is because they have a very different and reliable bias to growth and inflation outcomes. More specifically, if you think about what is the big driver of asset class returns through time, it's typically big changes in growth and big changes in inflation. And this is all relative to what is already discounted. The market is trying to always guess how growth is going to transpire over time, how inflation is going to play out. And it's the big surprises that really move markets. Surprises to the upside, surprises to the downside for both growth and inflation. So if we pick assets that have a different fundamental bias to various growth and inflation outcomes, you can effectively neutralize that big risk of growth and inflation moving around. And effectively what you're left with is this third environment that we'll talk about today. We've talked about the last few quarters, and actually we've talked about it since we started doing these webcasts 3 years ago, which is there are these rare environments where cash is king, where diversification doesn't work that well. And so that's basically something you can't really diversify against by building a balanced asset allocation, whether if it's 60-40 or a risk parity portfolio. Those environments don't happen very often. They're usually short-lived, and markets typically recover afterwards. So we'll talk about that in a moment. But the focus here is diversify to growth and inflation. We know equities have this bias to rising growth, falling inflation. Commodities are a rising inflation asset. Within commodities, there are two subgroups: commodity producers. Think of miners, energy, agriculture. That's a rising growth asset, whereas gold is a falling growth asset. So first quarter of 2020 is a perfect example. Growth collapsed, commodity producers went down a lot, and gold was up. But they're both rising inflation assets. TIPS have the opposite bias of equities. That's one of the reasons they're low correlated over time. And then treasuries, falling growth, falling inflation. So by diversifying across those four, we basically check off the boxes of growth and inflation in terms of diversification. Then the second step is to take each of those asset classes and own them in a way where the long-term expected return is competitive with equities. So equities, you can just buy the index, you get equity-like return and risk. Commodities, what we do there is we own a commodity basket that consists of commodity producer stocks, which have a very competitive return with equities. I'll show you that in a moment. And then gold, which is actually kept up with equities for a long period of time. And that basket, we think, has a competitive return and risk with equities, but it's a much better inflation hedge. TIPS and treasuries are normally low risk and low return, but there's two levers we can pull to raise the risk and return. One is owning longer duration treasuries and TIPS, and the second is to apply a modest amount of leverage. And we think if you do that, you can actually get a competitive return with equities over the long run. And that's essentially because over time, these two asset classes, TIPS and treasuries, have a similar Sharpe ratio, return to risk ratio. Typically, investors buy them with lower risk. You can raise the risk, as I just described, and over time, we would expect a competitive return. Then what you can do is basically take that investment framework, wrap it inside of an ETF, which is what Rpar and Upar are, and you gain all these efficiencies. So first off, it's a very well-diversified, well-balanced portfolio because it has exposures to assets that do well in different growth and inflation outcomes. We take an index approach. We think it's very difficult to time markets. So what we're basically trying to achieve here is just a balanced portfolio that is kind of timeless and universal. And so we basically try to get that index exposure with those four asset classes that I described earlier. We automatically rebalance on a quarterly basis. And that's this repeated process of buying low, selling high. We try to maintain a very tax efficient allocation. The ETF structure gives you a lot of tax advantages, but even within the management of the portfolio, we try to minimize taxes. So Rpar has never distributed a capital gain to date. And it's obviously very liquid. It's in an ETF structure. Rpar has about 1.1 billion in assets. Upar is relatively new. It's growing. It's under 100 million still, but it's growing relatively quickly. Rpar started in December of 2019 and Upar about a year ago. The leverage of Rpar is about 20%, and Upar, which is basically 1.4x Rpar, has 68% leverage. The expense ratio is written on the screen here, and each ETF tracks an index that we created. The Advanced Research Risk Parity Index is what Rpar follows. There's more information on our website on that index. And then the Advanced Research Ultra Risk Parity ETF is the index. The Advanced Research Ultra Risk Parity Index is the index in that Upar tracks. Going back to that efficient frontier, this illustrates where we think Rpar sits and where UPAR sits over time. And what you'll notice is you can think of Rpar as equity-like expected returns with less risk, and UPAR with equity-like risk with a higher expected return. Most importantly, you're not sacrificing diversification to increase the expected return. So as you move from Rpar to UPAR on this chart, you'll notice the slope does not flatten like it does when you go from 60-40 to 100% stocks. And it's because you're basically taking that well-diversified portfolio and levering it a little bit to increase the expected return and risk. The allocation for Rpar and UPAR is provided here. It's actually a very simple mix. We think the concepts here are so powerful, we don't have to get too fancy in terms of the allocation. A quarter is in equities, a quarter is in commodities. That's split commodity producers and gold, 15%, 10%. And then we can't do 25% long treasuries, 25% long tips. That's not going to give you the balance you need, because long treasuries, long tips are not as volatile as equities in that commodity basket. So we have to own more to get to equal risk contribution. That's why there's 35% in treasuries, 35% in tips. When you add all that up, it adds up to 120, which is where that 20% of leverage comes in. And the way we achieve that leverage is also fairly efficient. For the treasury exposure, rather than buying treasury bonds, we own treasury futures. And that effectively allows us to get that excess exposure, that 20% extra, and the cost of financing is very attractive. So it's extremely well diversified and with cheap financing. UPAR, you'll notice the pie chart looks the same. It's just levered up 40% more than Rpar. So the allocation, the exposures are identical. It's just going to be 40% more risk, meaning more volatile, and we expect 40% higher excess returns. I mentioned this concept of a rebalancing boost. I think this is something that is often underappreciated. This is a simple example that we show on this page, where we took two return streams that have the exact same total returns, but the numbers are scrambled. These are just random returns. And so these two individually have the exact same 8.1 return, same volatility, a little over 15%. If you put 50% in each of those portfolios and you rebalance back to that 50% allocation once a year, after 20 years, by investing in two assets that give you 8%, you end up with 9%. So how can you get 9% out of two things that earn 8%? It's because of this rebalancing boost. And this is a very simple example. We know the risk goes down. This 10.7 is lower than the risk of the two. That's well understood because these are diverse assets. But the return boost is something that surprises people. And as I mentioned earlier, that boost tends to be greater the more diverse the asset classes and the more volatile the asset classes. And the reason is you get more divergence across time in terms of those asset classes. So the buy low, sell high strategy tends to work better. And we think risk parity takes more advantage of this principle than most other asset allocation strategies. And it's because we're investing in more diverse asset classes that are individually volatile. So Rpar has only been around a little over 3 years, but these asset classes have been around a long time. On this page, we show you the index returns for the markets in which Rpar and UPAR have exposure. And these returns go back to 2000. So this is from January 2000 until the end of last year. So it's about 22 years. I think some of these numbers might surprise people. MSCI World Index, which represents global equities, has earned 4.6% per year. It sounds low, but that's largely because we're coming off a really strong bull market decade. The previous decade, equities were slightly negative. So that averages to 4.6% for 20 plus years. Treasuries, this is long-term treasuries, have actually outperformed equities over the last 20 plus years with less volatility. These are unlevered returns, and the correlation to equities has been negative over that time period. Long-term tips, 6.2% a year, over 1% a year better than equities. That probably surprises a lot of people. Commodity producer equities, this index started in December of 2002, and the returns are significantly higher than global equities. The volatility is also higher. And then gold, since 2000, over 8% a year, with low correlation to equities. Here are the same returns divided up into 5-year blocks. And the reason we do this is because we want to show how much the leadership changes over longer timeframes. So if you go back to the 2000 to 05 and then 05 to 2010 periods, equities were at the bottom. That was the worst performing asset class across these 5. Then the following decade, it was the best performing asset class. Gold has bounced around, commodities have bounced around, all these asset classes move around pretty significantly. And what's interesting is if you just look at the average asset class return for these periods, they're relatively strong for all periods. It's much less likely that you get a bad extended period, call it 5 years or 10 years, when it's a well-diversified portfolio as opposed to a single asset class, equities being the common example. The other thing you'll notice is the returns have gradually come down. So 9.6 from 2005, and then 10, and then 6.6 and 5.8. And a lot of that is attributed to cash rates falling during that time period. So once we hit 2009, cash rates went to zero. They've hovered near zero. They've recently increased a lot. And so, these asset classes, all price versus cash, we'll talk about that in a moment as well. But that's the other key observation from this chart. And then if you look at this at the bottom right here, the 7.4%, this is if you just bought the indexes, equally allocated across all these assets, just to give you an average, rebalanced once a quarter, you would have earned 7.4, several points ahead of equities, and ahead of 60/40. And this is for 20 plus years. The other comment or question we often get is, when there's a severe economic downturn, correlations go to 1 across assets. This is a table that shows you the returns of equities during the last 4 significant economic downturns: the 2000 crash that lasted almost 3 years, the 2008 financial crisis, still very memorable, even though it's 15 years ago now. The Eurozone crisis, that was a 6-month period where markets fell 20%. And then the 2020 global pandemic, just markets, the MSCI World fell 21% in 3 months. So these are 20 to 50% drawdowns for equities. 60/40 portfolio did poorly during all those periods. It's because its main asset is equities, and equities are going to drive the returns of 60/40. But when you look at the other asset classes, commodities, gold, treasuries, tips, particularly gold, treasuries, and tips, actually held up quite well in each of those economic downturns. These are assets that are typically missing in the traditional allocation. This is what makes portfolios more balanced, and you can see that in severe economic downturns. And obviously, there's a lot of talk about maybe there's a recession around the corner. I think it's important to own assets like this just to give you some downside protection.
Alex, I have a question.
Yeah.
After a long time of continuous rate cuts helping fixed income performance and therefore risk parity's performance, how do you think about the changing rate environment and its influence on Rpar? Would you expect less of a positive outlook for performance given that change?
Well, a lot has changed in the last year. So a year ago, rates were extremely low. They were low for a reason, and now they're much higher. So I think that question or concern is probably less relevant today than it was a year ago. But regardless, the way we think about this is all these assets price versus cash. And the simple way to think about it is if cash is yielding 0, then an investor may be comfortable with owning stocks that earn 6 or 7% above cash, which is that long-term average return above cash. Because as an investor, you can take no risk, get whatever the risk-free yield is. It used to be 0, now it's heading towards 5 or so. or you can take risk and invest in risky asset classes. And there's a mix of asset classes in which you can invest. They should each offer you an attractive return above cash. And so when we talk about the interest rate environment, we don't think of it as just necessarily impacting tips or treasuries where you see that yield. It impacts all asset classes. And that table that I showed you earlier, where you could see the average return of asset classes coming down over time, basically coming down with cash. And if cash jumps up like it has, then we would expect the asset class returns to increase over time. So that to us has nothing to do with how you get diversified. That's more about the level of expected returns across the board. We think diversification always makes sense, regardless of where rates are, because rates can always fall lower. They can, always rise, and it just makes sense to be more diversified, especially if you're not giving up anything over the long run.
I'd also say that, the rate cuts, to echo Alex's point, the rate cuts have been a benefit for all asset classes. So yes, it has benefited bond prices, but it's also benefited stocks tremendously. We think that tailwind may be coming to an end, and we may be in an interest rate environment where you don't see those ultra low levels of rates, or the Fed may not be in a position where they can cut rates so aggressively in response to economic weakness. And actually, if you go back to historical periods where that's been the case, like the 70s, that tends to be a very good environment for the diversifiers that we have in the portfolio. So for instance, if they don't respond aggressively, then you could have a higher inflation environment, which could benefit commodity exposure, both gold and commodity linked exposure. It could benefit tips. And in those higher inflation environments with weaker growth, like the 70s, that was a very challenging period of time for traditional stocks and bonds. But if you hold that balanced mix of asset classes, you tend to have an outcome that is as attractive. And so that diversification, I think, will take on greater importance actually in an environment where the Fed isn't supporting asset markets to the degree that they have. And I think what you'll find actually that a performance in a diversified portfolio like this is likely to hold up much better than something that's more concentrated to traditional stocks and bonds.
Yeah, and I think we can actually see some of that playing out on this chart that I have on the screen right now. So Rpar started in 2019, and we've been through 6, and possibly we're now in a 7th. It's hard to know this early, but through these very different environments. And if you go back to where we started, the goal here is to diversify against the key factors that are diversifiable, recognizing that there are certain things that you can't really diversify against by being long public markets. And so you just have to recognize what that residual exposure is. So Rpar, we think of it as being diversified to growth and inflation surprises, and you can't really diversify against environments where cash is king. And there's basically 2 types of environments where cash is king, where cash outperforms a balanced mix of assets. One is when there's a panic and investors just flee for cash because they're just terrified of what, that the world's going to end. And then there's this environment of a tightening. And what that basically means is cash is all of a sudden becoming more attractive because the Fed is aggressively raising interest rates, giving you a higher yield for taking no risk. And so asset classes all behave similarly to that factor, meaning they all decline at the same time because they all compete with cash. And that's very difficult to diversify against in a static, balanced asset allocation. So we've seen all those things play out since Rpar started. So when we first launched in 2019, growth was weakening pretty significantly. Equities were down materially. Rpar was up 2% during that time. So it's 2% in about 3 months. So that's you think of that as like an average type of return. Then the panic hit when COVID first struck, and people thought, or had no idea how things were going to play out. It was about a 2-week period. Rpar was down 16%, as you would expect given what happened. But then stimulus came in. The Fed cut interest rates, started printing money, and all asset classes responded favorably. And so Rpar after having a period of significant underperformance, had a period of significant outperformance, 31% in 4 months. That's much better than you would expect during normal times. Then that stimulus resulted in growth rebounding. Economic growth started to rebound, and the asset classes responded as you would expect. Rpar up 9% in about 14 months, average type of returns. That growth then started to result in inflation pressures, the highest inflation we've seen in 40 years. That's typically not great for equities or things like treasuries. But the inflation assets did well, and Rpar is up 2% in 5 months, average type of returns. Then we had the tightening environment, where the Fed realized inflation wasn't going to be transitory. They had to aggressively raise interest rates, and all assets fell in price, and Rpar down 26% in 7 months. Now the question is has that period ended? So you could basically go back in time, and it looks like about the end of the third quarter is when the market started to discount. Okay, the Fed is going to stop raising rates soon, and actually today they're expected to start cutting interest rates later this year. Then what that did is it caused all assets to rebound, and Rpar up 8% in a quarter, which is much better than you would expect during normal times.
Alex, there was a question from an attendee as to why we don't include that 2022 drawdown you just referenced on page 11.
Great question. So the reason we didn't do that is this is not a chart for when equities go down. This is what we're trying to distinguish here, is when there's an economic downturn and the economy turns down, typically that's what causes equities to fall. And that's something you can diversify against. That's that weak growth environment that I described earlier. And that's something where these other asset classes are going to hold up well. Growth we're not living through 2008 or 2009 or the 2011 Euro crisis or the global pandemic where unemployment quadrupled in a matter of months. This is more equities have fallen, not because growth has weakened, but because of this significant tightening, just as all asset classes have suffered. So that's a very different environment. And we're gonna separate that into a different type of discussion because it's not the same as the growth shocks that we've experienced in the past. So walking through those environments that I just described in a little bit more detail. So we had 2019 growth weakened, equities fell 7% in a relatively short period of time. Commodity producers were down a lot. Treasuries, tips, and gold rallied, and those asset classes responded exactly as you would expect, given their bias to growth. And Rpar did fine. 2014, on page 14, once panic hit, everything fell at the same time. Investors were selling assets for the safety of cash. Rpar down 16% in a short period of time. Then the Fed stepped in, significant easing, monetary stimulus, printing money, everything rallied. You actually very strong returns across the board, across all these assets. Rpar up 31% in a short period of time. Then the economic impact of all that easing started to play out, and growth started to rebound. The assets that are biased to do well when growth does well, equities and commodities did best, and then treasuries trailed, as you would expect. That's a falling growth asset, and Rpar did fine. Then inflation started to become an issue, and so that we haven't seen since the 1970s and early 1980s. And equities and treasuries both did poorly at the same time, and that's not a surprise. They don't always have a negative correlation to one another. That correlation is just a byproduct of the environment. When inflation is the big driver of asset class returns, as it was for about 5 months last year, both equities and treasuries have the same bias to inflation. So they're probably both going to be underperforming in that environment. And the other inflation hedges did well. And Rpar just had a normal period during that time. Then we had the tightening, and that was very painful. It lasted about 7 months. We think it's over. Obviously, that can change, but that's If you look at the data today, it looks like it lasted about 7 months. You had significant declines across the board. One thing you'll notice is long-term tips and long-term treasuries actually underperformed the other asset classes. And it's because they're most directly related, their prices are most directly related to the movement in interest rates. And so that's not a surprise. Later on, we'll talk about tips in particular. There's a lot of questions about tips with high inflation. Why were tips one of the worst performers last year during that tightening phase? But it's basically, they're directly linked to movement in interest rates. The other assets are gonna, they're also impacted by interest rates, which you see there, but they'll also be impacted by how the environment transpires after the tightening takes hold. So now the big question is has the tightening peaked? And what I mean by that is not, is the Fed going to stop raising rates? The market's already discounting that. That's already in the price. It's, are they going to raise rates more or less than what's already in the price? So inflation pressures are subsiding. We can all see that data. Investors have responded by reducing expectations of future tightening. And as I mentioned earlier, there's actually easing discounted. The Fed's actually going to raise rates maybe 1 or 2 more times and then cut rates. That's what's in the pricing if you just look at the yield curve. And so that has produced a tailwind for all assets. So if you look at this, you can see pretty significant returns for a quarter across the board. Treasuries were down slightly. We could fast forward this through January of this year. Rpar is up 6 to 7% in January. All assets are up a lot. Treasuries have actually rallied in January. And then UPAR is up 8 to 9% in January. So I think an important point is the tightening that we experience is not unprecedented. We had a very similar environment in the early 1980s when Paul Volcker, the Fed chairman at the time, stepped in, and his objective was to end the inflationary period of the 1970s, where inflation was high for a long period of time, for a decade. It started low and it just kept creeping up until we got to the end of the 1970s, and inflation was over doubled, 12%, and it eventually hit 15%. So he came in, very aggressively raised rates. You can see the chart here where the market started discounting that rates are going to be increased pretty significantly as that became obvious. And in real terms, the expectation was an 8% increase in rates, and that happened over a 2-year period. So you can see how asset classes responded to that. Equities, treasuries, commodities, and gold were down 20 to 60% during that 2-year stretch. And then what happened is once that tightening eased and the expectations shifted, you saw a very significant bounce in all those asset classes. And by the way, we're looking at this net of cash, because at the time cash was yielding very high, and we always think of these returns in excess of cash. So we compare that to the current period with Powell. Inflation was running at 7%, came in and started aggressively raising interest rates. This chart is actually, the slope is steeper than during the Volcker period. Over just a 7-month period, real rates were expected to go up almost 5%. Volcker was about 8% over a 2-year period. So this is a material tightening, just like we saw in that period. And asset class returns across the board were down significantly. Commodities, these are commodity equities, actually held up because you had the energy shock that supported the prices there. And now the question is are we in the post-tightening phase? And as I showed you earlier, the returns of these asset classes have pretty significantly bounced. So one topic that I think is useful to talk about, as I mentioned earlier, we're trying to diversify to growth and inflation. We think this is a more diversified portfolio than an equity portfolio or even a 60-40 portfolio. Now, one of the risks is that investors have the wrong reference point. And what I mean by that is most investors have an equity concentrated portfolio. That's just the standard today. Um, and the challenge is, if you're comparing a portfolio that's more diversified than one that is more equity concentrated, it's not necessarily going to zig and zag at the same time. And if you go through a period where it's underperforming equities or an equity concentrated portfolio, there's pressure to think that it's not doing its job. The objective here isn't necessarily to track equities. If anything, it has a relatively low allocation equities. As I mentioned, Rpar is only 25%, and it has a high allocation to other diversifying assets to equities. And those are relatively volatile. So the returns of Rpar and Upar won't necessarily track equities. It's not clear that it's going to go up, less during bull markets and down less during bear markets. It's just different exposures. And so we encourage our investors to think more in absolute terms, building a more diversified portfolio than to comparing it to an equity oriented allocation. I'm going to shift now to performance. Q4 was a strong period. Rpar was up just under 8%, outperforming 60-40 and a little bit behind a 100% equity portfolio. For the year, down 22.8%. So a really tough year for a balanced portfolio. As I mentioned, it's the tightening that caused that, even though you had a pretty strong rebound since then, and another strong rebound in January. But if you look at the last 3 years, 2020, Rpar was up over 19%. That is above expectations. So that was a outperforming year. 2021, kind of right in the middle of what you would expect, up 7.5%. And then 2022, underperformance. And then if you look at 2023 so far, ahead of where you would expect it. Looking at the individual asset class returns that make up the returns for Rpar, I think it's also interesting to go year by year. If you go to 2020, the best performing asset class was tips, up almost 26%. And then this year, it's the worst performing asset class. The worst performing asset class in 2020 was commodities. And in the last 2 years, it's been the best performing asset class. So it's similar to that chart that I showed you earlier about those 5-year blocks. Even year over year, you get significant shift in leadership. And that's another reason why it's important to be diversified, is it's really hard to time these things. It's hard to know what's going to do best next. Oftentimes it's the worst asset class, and our natural bias is to avoid the things that have done poorly in the past and pile into the things that have done the best. And oftentimes, as you can see, plainly on this page, it's almost the opposite, but the timing is just really hard to get right. So that's why we just stay diversified all the time to all these asset classes. The attribution is just the allocation times the returns of the underlying asset classes. One interesting point on last year, if you just look at treasuries and tips, that negative almost 9% and negative 12% for treasuries and tips, that adds up to about 21% of the minus 23. So almost the entire decline can be attributed just to those two asset classes. And what's interesting about that is those two make up 70% of Rpar. That's the target allocation to long-term treasuries and tips. And the yield of those two asset classes has gone up materially in the last year. That's why the returns went down. So looking forward, they're a lot more attractive than they were just a year ago. Upar is essentially a more volatile version of Rpar. So it went down more in the downturn, and it's rebounded more on the rebound. And it's up 8 to 9% in January. So almost 20% from the lows in about 4 months. It's going to have similar exposure to the asset classes underlying it, but there is leverage, which is why you'll notice, since inception, it's down almost as much as the single worst performing asset class. And in fourth quarter, it's outperformed 4 of the 5 asset classes. That leverage goes both ways.
Alex, a question about how we implement the leverage.
Sure.
Why do we use Treasury futures instead of buying actual bonds like we do with TIPS?
There's two reasons. One is with Treasury futures, they're actually more tax efficient than Treasury bonds. When you buy a Treasury bond, it has a yield, so that income has to be distributed out of the Rpar ETF. Whereas with futures, there is no income. The return is all capital gains, and it's generally treated as 60%. It has a 60-40 split between long-term and short-term capital gains. But those capital gains can be offset with capital losses if we're able to generate capital losses. So it gives you the opportunity to actually generate no capital gains if you do that well. And even if you distribute all of it, that's still more tax efficient than income. So there's a tax efficiency advantage. So that's one. But more importantly, that's the way we get that extra leverage, that 20% of leverage. So one way to do it is to buy physical securities across the board, including treasuries, and then borrow 20% to get that leverage. That cost of financing of borrowing is going to be higher than by getting that leverage through the use of futures, because the implied cost of getting that leverage within futures is going to be competitive with cash, which we think is a very attractive way to borrow. Continuing with UPAR, the attribution you can see on your screen there. It's basically the allocation times the asset class returns. So I'm going to shift to frequently asked questions that we get from our investors, and I'm going to ask Damien these questions. Are you ready, Damien?
I am. Before we jump into the
Yep.
frequently asked questions, let me ask one more question that we just received.
Sure.
Many investment strategists recommend a small allocation to alternative assets. Do you consider UPAR to be in this asset class? And if so, how does it square with returns observed in Rpar this year, which were as bad as stocks?
Yeah, you can think of both Rpar and UPAR as an alternative investment, but it's not exactly the same as buying, a private real estate or something like that, or a hedge fund. So the way you can think about where this fits is typically there's an allocation to equities, there's an allocation to fixed income, and then alternatives is a broad bucket that covers everything else. So obviously Rpar and UPAR have some equities in them, some fixed income, but they own other things. And so it doesn't fit cleanly in equities or fixed income. So it falls into the alternatives bucket. And you can think of it as a liquid alternative. Many other alternatives are not liquid. It's also generally very tax efficient. Many other alternatives are not tax efficient. So it's differentiated in that way. But it's not going to act like the other alternatives. It's basically a more diverse asset allocation. It gives you exposure to these other asset classes that most portfolios don't own. Most people own equities, global equities, but there's very little exposure that we've seen in TIPS, commodities, gold, even commodity and treasuries, even long duration treasuries. That's going to act a little different from traditional bonds. So think of it as giving you exposure to those things. Now you can get even more diversified by adding other alternatives that give you exposures that are different from what's inside of Rpar and UPAR. But the risk of including that as an alternative is that you may go through periods like we just did where you have a tightening, and that exposure isn't going to hold up in that environment. Or if you have a period of panic, it's not going to hold up. But then you typically see a pretty significant rebound. So think of it if you think of it in those terms, then I think it's a very good complement to a traditional stock and bond portfolio. So related to what was just asked, Damien, this is probably the most common question that we get. So why did diversification not work in 2022?
Alex alluded to this earlier during the performance review section, but 2022 was a very unusual year in that you saw the fastest rate of central bank tightening that we've experienced in over 4 decades. The Federal Reserve and other central banks, but the Federal Reserve specifically, because I think that's the one people most follow, raised interest rates 4.25% in the span of 9 months. That's as aggressive as we've ever seen. And this was their effort to try to rein in these very high inflation rates that we've been experiencing in our economy. And the effect of that has been to drive down the prices of all assets. So the tightening flow through to asset markets is a negative influence to all assets. There's nowhere to hide, essentially, because the return on cash is going up. So those asset prices have to fall in order to generate forward-looking returns that are now competitive with a much higher cash rate. That's most obvious in bonds because you've seen bond yields surge higher, but that's essentially what's happening to stocks as well. Earnings yields have to go higher, and that is going to impact virtually every asset class. The yield on real estate has to go higher. So that common risk factor is what's been dominant in terms of driving asset class performance. And what's interesting is that even today, you continue to see the influence of what is the Fed going to do being the dominant influence on assets. So normally in this strategy, we would see some benefit in terms of diversification to different growth and inflation outcomes. But the only thing that's mattered for the last year or so has been what's the Fed going to do. And during the first 9 months of the year last year, that was a positive influence. That was a negative influence for assets. And since the end of the third quarter, there's been a hope as inflation pressures have eased somewhat that the Fed can be less tight. And we've essentially discounted the end of the tightening cycle. And so that's worked in reverse and it's benefited all assets. So everything has risen together. And so you really haven't seen the benefit of the strategy over the past year or so, because there really isn't much benefit to diversification in this environment. We will eventually move beyond this tightening cycle, and you will see a flow through of that tightening to economic conditions. If they've not done enough, maybe you see higher rates of inflation. If they do too much, maybe you see a significant recession. But in either case, we believe that you'll transition to an environment where economic conditions drive asset class outcomes. And there you will see, we expect, a much greater dispersion across assets, and things won't just trade together in lockstep as they've been doing over the past year.
And importantly, we don't know when that's going to happen. I don't think anybody does. But also, there is significant risk of where growth and inflation are going to end up. There's a lot of pressures on growth. Inflation's the highest it's been in 40 years. Are they both going to go back to normal, or will they overshoot or undershoot that target? That's really difficult to know. The Fed is trying to get it just right. The market's expecting they're going to get it just right. There's a lot of risk around that. And it makes a lot of sense to be diversified to those things, particularly if you're not giving up anything over the long run to be diversified. And that's basically I think the main point for today is you're not going to see the benefits of that diversification when you get the tightening and then the subsequent easing. But at some point, those major factors will start to flow through and impact asset class returns, and you should be diversified to those things. So maybe digging in a little bit more. So we talked about this a little bit, but if risk parity is balanced, talk through how it was down so much in a relatively short period of time.
Yeah, I think
it's the first 3 quarters.
It's helpful to illustrate the points we were just making with the actual market performance. And so you can see the assets that are most directly influenced by the tightening, the fixed income oriented asset classes took the biggest hit, more or less in line with equities. So there really wasn't meaningful diversification across those components. And that's what produced the drawdown we experienced, which is on par with the largest drawdowns we've observed in risk parity strategies over the last 50 years.
So if we're looking forward, we just talked about this a little bit, but what's the argument for a risk parity allocation as opposed to something that's perhaps less diversified?
Well, the first point I'd make is that these periods of tightening, they tend to be short-lived because capitalism requires that investors are compensated for taking risk. And so over time, assets have to generate a return above cash. So what we've experienced over the past year has been an adjustment as assets keep pace with a now higher cash rate regime. But on a forward-looking basis, we would expect assets to eventually outperform cash And the silver lining to the pain we just experienced is that assets now are offering you much higher returns than we've experienced over recent years. And again, because cash rates are much higher than what we've experienced over recent years. So that's one aspect, is that we believe that this type of environment is short-lived and that the forward-looking returns should be much higher as a function of that repricing. The other aspect is specific to this environment. We think this is a very risky environment generally. You have a lot of dynamics at play that are very unusual. We just recovered from a pandemic. It created this surge in inflation combined with unprecedented government involvement in markets. And as the government withdraws that stimulus, you're now seeing a lot of these things work in reverse. And we don't know if they'll be able to thread that needle, as markets currently discount, around engineering a soft landing where they can get back to their 2% inflation and 2% growth targets. We think it's very unlikely that you're likely to see overshoots or undershoots on those various influences. And as we fully discount this tightening cycle, you'll start to see a flow through of that tightening to economic conditions. It's possible that inflation stays more elevated than what we've been used to, that 2% level that we've had over the last few decades. It's also possible that the Fed engineers a significant recession in order to bring that inflation back towards their targets. In either case, we think that is a very risky environment, higher inflation, weaker growth for equity markets. The worst periods of time for equities in the past have been the 2000s, when you had a very weak growth outcome, and the 1970s, when you had this stagflationary environment of elevated inflation rates. And so that is the type of environment where we think diversification, or those types of environments, are the environments where diversification matters most. And we think it's critically important that investors have asset classes, have exposure to asset classes that can do well in those environments that are less favorable for equities.
We've talked about inflation, and obviously Rpar wasn't around in the 1970s. I think it would be helpful to provide some context of asset class returns during that time period.
The 70s is instructive because you saw inflation rates surge from 6% to 13% over that period of time. It was a chronic issue in the economy and for financial markets. And so it's instructive to look at asset class performance during that period of time. That was the last time we had, a real meaningful, persistent inflation problem. And if you look at the asset classes that are represented within a risk parity strategy, you can see that quite a few of them actually benefited substantially from that environment. Gold and commodity futures, because we don't have commodity producer returns from that period of time, but I think you can extrapolate that commodity future performance, at least in part, to what you'd expect from commodity equities. But additionally, there weren't tips in the 1970s, but tips in that period of time, we believe, would have done well because real yields were stable or falling. At the same time, you had very high rates of inflation, which would have been passed through in terms of the yields you would receive from tips. So you had, three meaningful asset classes that are exposures within risk parity do very well in that environment. Of course, the asset classes we are most familiar with, the ones that make up the 60-40 approach, did very poorly. They actually underperformed cash. Equities and nominal bonds, or treasuries in this case, underperformed cash for actually more than a decade in that inflationary environment. So we think, we don't know, actually, I want to make that clear. We don't actually know what's going to happen looking forward. It's possible that we could see inflation fall meaningfully here, continue to fall meaningfully as it has in recent months. And we could end up back in a pre-COVID type of inflationary regime. In that environment, we would imagine you would see a slower rate of growth that would accompany that. And there are diversifiers here that would do well in that environment. But I think there's a higher probability than usual of a meaningfully higher inflation regime going forward. And it's important, we think, for investors to consider having inflation hedges in their portfolio.
I think the other important point about the 70s is there was a question earlier about if we're in a different interest rate regime. In the 80s and 90s, you had interest rates falling from high levels to low levels until they hit the lows just before COVID or just after COVID. And the question is how does this, how would you expect something like this to perform in a rising rate environment? If you look at the 70s, that was the environment in our history where you had the biggest move in interest rates, moving up, where rates went to mid-teens or so. And the key is what caused the rates to rise? They don't just rise on their own. There's some economic influence that forces rates higher. And it was rising inflation. Inflation just kept creeping up for a decade, and rates kept going up and up and up and up. And so if you think about how you protect yourself in that environment is by owning the assets that are biased to do well when inflation surprises the upside, which is what causes rates to rise. So with tips, commodities, and gold, those three asset classes make up half the exposure in Rpar and Upar. And so you had this period of rising rates. You have the exposure to those assets that are biased to do well, that historically did well. And that gives you that protection against that environment. So it's not necessarily that if rates rise, it's bad for risk parity strategy. It could actually be a very good environment. It may not be good for treasuries, but it would be good for the other asset classes. Treasuries are there for a different purpose. So we hit this a little bit, but maybe you can go into a little bit more detail. If you get this economic downturn, because we just talked about inflation, there's risk on inflation. There's also, a lot of concerns about a big recession coming down in response to the massive tightening that we've received. How do we diversify against that growth shock?
So we think a lot in the design of Rpar and Upar around having recession or weaker growth hedges in the portfolio. And specifically, those include treasuries, tips, and gold. Those environments of weaker growth tend to be very beneficial for those assets because you tend to have a flow through to easier monetary policy and lower interest rates, which benefits those asset classes. If you look at periods of economic weakness in the past, these big growth shocks that we've experienced, people often describe these environments as environments where correlations go to 1 and everything underperforms. It's because the dominant exposure in most client portfolios are equity and equity-oriented things. Even the fixed income allocations today look a lot more like equities, high yield and MLPs and REITs and various things that produce income, preferred equities that are actually very correlated with equities in a downturn. And you don't have things like gold and treasuries that tend to do well in those environments. So if you look back at these periods of time where you've had these growth shocks, you can see the benefits of having meaningful exposure to those low growth or recession hedges. And that is a very conscious effort on our part to include those assets in a portfolio because we think that diversification benefit is so crucial in those environments.
And it's not just an accident that these assets are either highly correlated or negatively correlated during a growth shock. High yield bonds have a similar bias as equities to growth. As does the typical hedge fund if you just look at the hedge fund index. And so the fact that it's going to be more correlated to equities in an economic downturn, it's not a surprise because that's just their bias. Whereas treasuries and gold have the opposite bias. So it does make sense. They're actually more likely to be in a bull market when equities are in a bear market. One common question that we receive is, does risk parity not work well when the correlation of stocks and bonds increases, as it seems to be doing recently?
Yeah, it's interesting. If you look at correlations, they're very unstable. Most people do their asset class or their asset allocation analysis, assuming certain static correlations. But as you can see on this page, the correlation between something as basic as stocks and bonds moves around a lot. If you think about the economic drivers, that can help you explain why it is that correlation is what we're measuring. So for example, the correlation of stocks and bonds has been very negative over the course of the 2000s and 2010s. And that's because growth has been the dominant driver. And when growth is the dominant driver, whether it's a growth upside surprise or downside surprise, stocks and bonds have opposite sensitivities to that. During the inflationary period in the 70s and 80s, even into the 90s, inflation was the dominant driver. First, because you had this surge in inflation higher, and then you had a falling inflation environment being the dominant driver. And when inflation is more volatile, stocks and bonds share a similar sensitivity. So that's been the story historically. We don't know what's likely to transpire going forward, but the beauty of the strategy is that we are were agnostic to it. So in the environment like the 70s and 80s, when inflation was the dominant driver, you had inflation hedges in the portfolio that we talked about earlier that did quite well. And so you don't depend on just that benefit of diversification between stocks and bonds to do well in the strategy. You have other things that can do well when stocks and bonds are more correlated. The one exception has been what we've experienced over the past year. The tightening environment is negative for everything. The correlations go up across everything. But again, that is an environment that is short-lived, and we don't expect that to persist over long periods of time.
Yeah, and more specifically, it's a material tightening. So there's always, markets are always discounting the Fed raising rates or cutting rates, but it's when it's material. The last time we saw that was 40 years ago. So it's not very often where you get that, where it overpowers any other influence in terms of growth and inflation. One question we get is tips. Maybe talk us through how tips work. I think it's one of those things that is just not that well understood, and maybe describe why it didn't do as well last year when inflation was high.
Yeah, before I describe it, I just want to correct something on this page. So there was an error. The tips performance in the recent period should be a negative 16%, not negative 32%. We were using the wrong index for that. So tips, they are like treasuries, except instead of paying you just a fixed yield, they pay you a fixed yield plus the actual inflation, which makes them a great diversifier in periods of time when you have higher inflation. So normally, if you think about bonds, they would do poorly in a period of time when inflation surges higher and interest rates accordingly have to go higher. But tips actually can do well in those types of environments because you get a larger pass through in terms of the yield. Now, we get the very logical question from clients, why didn't tips do better last year? We had high inflation. And actually, from a yield perspective, tips did great. They actually delivered high single-digit yields last year, as you would expect. The challenge last year is that there are two things that drive tips performance. One is the yield. We can all understand that. It's just a fixed yield. Today, it's around 1.5% plus inflation. The other is the price change of the bonds associated with changes in real yields, which is something that people probably don't focus a whole lot on. So we showed this chart just to demonstrate how that influences tips returns. So the tips return you're going to earn is going to be that yield plus the price change associated with real yield changes. Just as in any other fixed income security, yields rising causes a price to fall. Yields falling causes the price to rise. And so if you're in a stable real yield environment or a falling real yield environment, you tend to get yield plus a tailwind of the prices going up. And conversely, if you experience what we experienced last year, you're getting that yield minus the loss associated with real yields going up dramatically. And it's been as dramatic as anything we've seen over the last 25 years. The real yield rise last year, you can see here on this chart, was nearly 3%. That's a big move. And that caused the price of tips to fall. Just as a proxy, if you think about the negative 16% number that I gave, you can think of the duration of that index as roughly, call it 8 or 9 years to real yield changes. And so 8 or 9 years times a 3% inflation move, that's like call it mid-20s type of loss in the price of the bond. And then that's offset by the high single digit yield. That's how you get to the 16% and the 16% loss that I quoted earlier. And so you have to think about both those aspects when you're thinking about your return from tips. Now, on a prospective basis, we experience that big real yield rise. We think we're likely most of the way through that. And on a prospective basis, you can actually earn 1.5% from tips plus the realized inflation, which relative to where you've been the last several years when real yields have been negative is really attractive. And so looking forward, if you buy an inflation index bond today, you're earning 1.5%, whatever the actual CPI is over the period of time that you hold it to maturity. That is a really, in our view, attractive return and a good diversifier for a portfolio where most things would actually have a negative sensitivity to inflation staying higher.
And if you look at this chart, the yield is about where it was in 2008 or 9. So almost 15-year highs now in terms of yield. And the forward-looking returns are always based on the yield as opposed to, looking backwards at the returns. We'll end on this page, Damien, which is the page we've ended on every time since for the last 3 years, which is in what environments does risk parity underperform? And I think the key here is we talked about the panic environment and the environment of tightening. But the key here is this is not something that's a surprise. We talked about it before those things happened, and we just don't know when they're going to. Obviously, if we knew when they were going to happen, we could do something about it. But it's really hard to know that. You don't know when they're going to start. You don't know when they're going to end. But what you do know is when those periods occur, you're probably going to have underperformance, and then when they end, you'll probably have outperformance. And then over most of the time, you have average types of returns, which is what we described. I don't know if there's anything else you want to add, Damien.
No, I would just echo that you oftentimes see the best performance after these painful adjustments. And so it's important in a strategy like this to remain invested. And what you're betting on essentially here is that assets over time will outperform cash. And if that assumption is correct, then we think it makes a lot more sense to be diversified than to be concentrated. And if you look at the performance of these types of strategies over long runs, over very long periods of time, you do see that. But over short periods of time, as we've just experienced, that diversification may not help you all that much. And that's for very understandable reasons. The other reason why risk parity underperforms beyond just the central bank engineered tightening is when you get a panic. And that similarly tends to be short-lived because you have a government response that eases that pressure. But that's the type of experience we had in 2020. And if you go back historically, 2008 and other sort of crisis risk off periods of time when all asset classes underperform because people rush to cash. So those are the reasons why it underperforms. And we always think about this when we hire managers or make allocations to different strategies. The first question we ask ourselves is, when is this portfolio likely to underperform? Because underperformance in and of itself is not a problem. Everything that you invest in, any manager, any strategy is going to go through good and bad periods. The critical question you ask yourself during the bad periods is this as I would expect given the economic conditions, given the environment that we're in? And if so, then it could be a time to add, right? Because then you basically, you would understand why it's happening and you would be able to hold through the trough. And that's why we spend so much time trying to educate our investors on what it is that can drive these negative periods of performance to make sure that, yes, that is actually as advertised, what we would expect in a strategy like this. And if you can then hold through the trough, oftentimes you have the best outcomes subsequent to the trough. So that would be a point that we would want to leave everybody with.
Yeah, and that's one of the main reasons we've included this slide in the deck for the last 3 years, is because we know those environments were going to happen, and we just want investors to be aware of it before the fact, during, and after, to help educate them to make good investment decisions. The other thing, just to end on this point, is because Rpar is diversified to growth and inflation shocks, and kind of exposed to these cash is king type of environments, you could actually look at Rpar's returns to get a reflection of what's happening in the markets. So if you compare it to, let's say, equities, and equities are down, it could be because growth is weak. It could be because inflation is surging. It could be because cash is king. It could be any of those. Whereas with Rpar, we don't think of it as, going down because growth is weak or inflation is surging. It's more because you're in this cash is king type of environment. It's not an exact science, but it's more diversified to that than equities or equity concentrated portfolios. So it's, in some ways, you can get a reflection of what is the big driver of asset class returns by just looking at the returns of Rpar. Do we have any other questions, Damien?
Those are all the questions that were submitted. Thank you.
Well, we appreciate you taking the time to listen. This will be posted on our website within the next few days or so. So feel free to go back. And if you have any additional questions, we're always available if you want to reach out to us.
Thanks for joining us.